Welcome back to Real Estate Economics Weekly Webinar Series. This is part 2 covering the San Francisco Bay Area. I'm John Mulville. Just so we understand the definition of this area, this Bay Area webinar is covering 11 counties surrounding the San Francisco Bay in all directions. Let's take a look at the household income growth in this area. As we discussed in part 1, this area has a lot of high-tech employment and a lot of employment that tends to benefit from stock options, bonuses, and pretty steady increases. So this area has enjoyed some very high median household income growth. Look back in the 90s, we were 5%, 4%, high 3% figures over a sustained number of years. That really tends to help household wealth accumulate and gives people the money to make down payments for homes. If you look in this current recession and the recent slow economic growth period after the last recession, we're down as low as 1% growth. That tends to make it very difficult to accumulate funds. Now what we're poised with here at the end of year 2010 as we speak, we've got the termination of the Bush-era tax cuts. A family of 4 in this state earning $60,000 will have $2,100 less take-home pay if the Bush tax cuts expire. That's obviously a tremendous loss in take-home pay and something that's bound to affect purchases, car leases, car payments, home payments, consumer goods spending across a whole bunch of categories if people don't have that same take-home pay. We think people are really underestimating this. It's a big political issue, but we think when people get their first 2011 paychecks, if there's not an extension of reduced income tax rates, that there'll be quite a bit of public controversy. Let's look at the supply and demand of housing in this area. As we talked about in part 1, the supply, shown in the blue, grows very slowly at a very measured pace, steadily throughout the time period from 1990 through the forecast period to 2015. By comparison, demand for housing is driven by employment, which has fluctuated and oscillated very severely in this particular market. You can see from 1996 to 2001, the demand for housing, all a function of employment, increased by over 700,000 units in this particular area. Recall our annual permits out here are just under 15,000, so there's no way this market could come close to adding 700,000 units in 5 or 6 years. What happens? That excess demand outlets itself to higher prices, and prices surge in this area. Then as you saw, the dot-com bubble burst and the demand came way down. We lost a lot of jobs, and we had somewhat of a period of equilibrium before the subprime era come along and the construction boom of 2006 and 2007. Now, as you can see, the demand for housing is well under the supply line because we've lost so many jobs. So that puts us in a condition where it's essentially a buyer's market. If you've got the money and the financial capabilities to buy, you're seeing a lot of good homes. You're seeing a lot of willing sellers. Many people, if they've got accumulated equity, they're moving into this area with some money, are moving into the premier markets. We've certainly seen demand accelerate here in the high-value urban areas, Pacific Heights and some of the other places where people have been priced out of some of the elite markets for many years. Now that prices have come down in those high-demand areas, they're seeing quite a bit more demand. Conversely, the outlying areas more remote from employment, areas that rely on local employment, have suffered quite a bit more. We can quantify that over and under supply numerically, but again, I like to look at this in terms of employment. Really, these areas are overemployed or underemployed relative to the housing stock. So when the employment is very good, the market surges above the red line in the middle, and the market is characterized as being underbuilt. We don't have enough homes for the employment force, for the job base. When the market is overbuilt under the red line, there's not enough jobs for the housing base, and the reverse happens. So as of right now, the dotted line on the right-hand side, the market is characterized as being overbuilt. Really, I'd like to look at that as being significantly underemployed. And as employment grows in this market area, we'll gradually reestablish equilibrium. In fact, we'll enter an underbuilt period during the forecast period in 2014 and 2015. Let's look at valuation. Now, historically, valuation has been closely tied to what sort of loan you could qualify for. Proper loan underwriting made most people, get a loan that they could afford, a loan they could pay back, and people, work very hard to pay that loan and keep that house. That whole process completely broke down in the subprime era. You can see this big spike, this big shark fin in 2006 and 2007. That whole process broke down, and people were getting loans that they couldn't begin to afford. There was no chance. It took a perfect scenario for the people to possibly hold on to those homes. Now we get a recession, we get some interest rate resets, and obviously it hasn't ended well, so we've had a huge drop in values. The only way, when people were getting all those loans for those ridiculous mortgages based on the stated income that they were providing, all that excess liquidity goes straight into prices, and you can see prices spiked up much more during subprime than they even did during the dot-com bubble period of 2001 and 2002. So come forward to 2010 and 2011, what sort of situation do we have? Well, the supportable median home price shown in green is much higher than the historical home price. So people in this market, based on current incomes, based on current interest rates, can afford a more expensive home than the current median price would indicate. Well, why don't people rush out and buy homes, people ask. If homes are significantly undervalued, like this data indicates, how come everybody's not out there buying homes right and left? Well, in some sense they are. Rental investors, people with cash, people who've been through this cycle a couple of times are buying homes across this market area for investments, for rental investments, for their kids, that sort of thing. But on a larger scale, collectively, the market isn't responding to this undervaluation because we've got poor sentiment, high unemployment, people are uncertain about their jobs, that sort of thing. But as confidence grows, as the employment numbers start to come back, we'll see those two lines converge, and equilibrium will be reestablished in this market and most of the markets we study across the nation. Let's look at median home prices and the changes that have taken place. You can see we had a tremendous run-up into the dot-com area, then really a sustained period through most of the early 2000s when we had steady growth despite the dot-com phenomenon. So even the dot-com phenomenon wasn't sufficient to drive us to negative price trending in this area. There was considerable pent-up demand in this area. Homes weren't really built in sufficient numbers through the 90s and through the 2000s, so there was a lot of undersupply of housing that even the dot-com era couldn't lead us to negative price trending. But look here, in 2008 and 2009, the subprime era was capable of making the pricing overstatement so dramatic, so significant that there's had to be a retrenchment take place. Now you might find it interesting, we've got year 2010 price appreciation at 9.4%. That number sounds huge. What's really taken place here on the ground is the percentage market share, if you will, of conventional resales, owner-to-owner resales, is capturing more sales, a bigger percentage. Foreclosures are capturing a smaller percentage. Foreclosures tend to be low-value transactions. Lenders are taking losses. Those are the lowest price sales in any given market area, whereas conventional resales are the higher price sales in any market area. So as foreclosures have declined, in part due to documentation and robo-signing, but in part due to higher lender recoveries on short sales, we've seen some price improvement here. Really is the mix of sales between foreclosures and conventional sales has readjusted and changed. forecast period, we've got steadily improving prices as the economic base firms and employment improves over the next 5 years. So how does that manifest itself in terms of over and under supply? You can see our peak high water mark in jobs back in 2000 at 3.6 million on the left-hand side of the chart, and we couldn't possibly keep up with supply as we've mentioned, so the market was characterized as being tremendously underbuilt. Again, there just simply was not enough homes compared to the size of the employment base. Come forward a few years and we lose, literally 500,000 jobs in this region, and the market's characterized as being tremendously overbuilt. There are simply not enough employed persons to support the housing base of this size. Now you can see throughout the whole time period here from 2000 to 2015, this market has not even added 200,000 homes. Less than 15,000 homes have been added here. So it's really not a housing supply problem. It's really not that so many homes have been built. We just have rows and rows of empty subdivisions. It's really a situation where jobs have been lost to such a tremendous degree that the employment base is not nearly large enough for the housing supply. Let's look at it in terms of valuation. The market became tremendously overvalued during the during the subprime era, obviously, because you could get a mortgage loan that was far greater than what you could pay back. That went straight through to the price side. Prices ran up from 480 in 2000 all the way up into the 800s in 2007 without that much increase in income. That was where the disconnect took place in the subprime era. Now we've had the payback, and we've gotten to a point now in 2010 that the market is tremendously undervalued. Household incomes have remained relatively high, but more importantly, 30-year interest rates have dropped tremendously. Look at the period 2008 to 2009. That's when the Federal Reserve began to intervene in the mortgage markets, and when you get a full 100 basis point drop in interest rates, now it takes a much smaller portion of the household income to afford the median home. So homes right now are tremendously undervalued. People, if they have a stable employment situation, if they have accumulated equity, relocation buyers can come into this market and buy a home at historically low levels of ownership costs and really lock down an excellent bargain for the next 15 or 30 years, as long as it takes to pay off that loan. Most of what you've seen here today comes from our residential economic report and our opportunity risk report. We call it the OR. You can see all these overbuilt and underbuilt relationships. You can see the overvalued and undervalued relationships, and we make a 24-month forecast for conditions on the ground, so you can see those changes. We merge those two, the overbuilt and undervalued, overvalued relationships. We merge those into a single document, and you can see when market improvement should be coming along, and just really the magnitude of the improvement that we expect based on these long-term and time-tested relationships. If anyone's interested in sponsoring a webinar, please let us know. Some of the things we do on our consulting side here at Real Estate Economics, we do a lot of work for financial entities, asset valuation, as is values. There's many broken subdivisions out there. We do partially completed units, finished lot values. We do something called the land value optimization. If you've got a parcel of land that had a former use that looked good in 2005 and 2006 but needs a product change, that sort of thing, we specialize in that, and it's been amazing the sorts of values you can draw out by optimizing the product and doing some changes there. Workout, build out, and liquidation distribution strategies. Here's our team. Mark Babbs, the principal. Many of you know Mark. I'm John Mulville. Here's my contact information. If you see anything today that was interesting or you'd like to discuss or know more about, please let me know. Judy Dewell's our Director of Sales and Marketing. That's the head of the subscription part of our business. As I mentioned, the Residential Economic Report, our Housing Transaction Reports, our Builder Profiles, Development Profiles, that sort of thing. And Sandy Rivera can help you with customer service, get the most out of the products. We use them. We do. She can help you do the same. Thank you very much for joining us today, and please join us for our upcoming webinars, including Seattle and our national recap.